It is pretty common to run into self-employed clients who make great money. They have a great established business, but they are writing off tons on their taxes so that they don't have to pay a lot in income taxes. Very, very common. So, this loan program today is to help those self employed borrowers be able to get a great mortgage without having the problems of the taxes and the write-offs that they have on those. My name's Miles Pitcher. I own Superior Lending. I've been in the business since, well, a long time, 24 years now. And this is one of my favorite loan programs to help out our self-employed borrowers. Let's jump into it. So as mentioned, often our clients write off lots of expenses on their taxes. And on a traditional mortgage, a Fannie, Freddie, FHA, conventional loan, VA loan, we go off of what your taxable income is on your taxes. And if that shows very low, you're not going to qualify for the home. So the solution we have, one of them is a bank statement loan. And what we do is we grab 12 to 24 months of bank statements. And this can be personal bank statements or business bank statements. And we look at all the deposits that happen. We total up those deposits. We're just looking at the deposits. And so this also works great for people who have multiple sources of income. Maybe they are a door dasher and they have another side or part-time job. And so we get to count all those multiple streams of income and the deposits they have coming into the bank statements. So we add those up, and then what we do is we apply an expense factor, usually around 50%. If we get a CPA that can help us and write a letter, we can sometimes shrink that down to 25%, and that becomes the qualifying income for the client on getting the mortgage. So we're not even looking at tax returns. We're looking at what those deposits are and the expense factor applied. Very, very cool. So another cool feature of this is that this is not restricted by FHA loan limits or conventional loan limits. It can go all the way up to $3 million. Credit score 660 on higher. It really does reward you, though, if you're 700 or higher on your credit score. Down payment can be as little as 10%. It gets much, much better if you plan on doing 20, 25% down. That helps the interest rate tremendously. Most of these that we are doing are on primary residences for our self-employed borrowers, but there are other options. And then here's also another key one is that you may need to have 6 to 12 months of reserves. And this can also come in the form of your retirement accounts like a 401k or IRA account in there. A couple things you need to know on this is that the interest rate will be 0.5% to 2% higher than conventional loans. These are considered non-QM loans, which means non-qualified mortgage. It means that they don't follow Fannie, Freddie conventional guidelines, and that can be a good thing. Our debt to income ratio, which that's a mortgage nerd term, meaning how much of your income goes to pay your monthly expenses and the new mortgage payment. So that needs to be below 43%. Sometimes we can push it up to 50% with compensating factors. You can do it as a 30-year fixed, or there are options to do it as an adjustable rate mortgage on there. So let me give you a scenario. This is very common for us. In fact, I put a landscaper on here because I've done more of these loans for landscapers than any other self-employed business type. So let's say that they're doing an $800,000 home, 20% down, 30-year loan. They're going to need somewhere around $150,000, $175,000 of taxable income to be able to qualify. And that's the average over 2 years. Okay. If that's what their income is, 175, they're looking about $36,000 a year in income taxes between federal and Utah state. Obviously, um, expenses could lower that, but just we're going to use that number right now. Let's compare what this person would look like on a conventional versus bank statement loan. Again, these are ballpark made up numbers, but so our loan amount 640, our conventional loan will use a nice even 6%. Principal and interest on this would be 38.37 per month. Now with 20% down, a good credit score, they're going to be looking at a bank statement loan around 6.5% right now. $4,045 per month. So the difference in monthly payment on that is going to be $208 per month, or about $2,500 a year. Okay. If you take that and compare it against the bank statement versus saying, hey, I'm going to show the income, I'm not going to write off stuff, I'm going to qualify for the conventional loan. Well, that means you're going to be paying $36,000 in income taxes, or $3,000 per month in income taxes, versus just paying $208 more in a mortgage payment. So, sometimes it makes sense to do the bank statement loan and pay less in the income tax area. And really, if you look at that rate is not bad at all. That payment is not bad at all. So if you know some self-employed people who are writing off a ton of stuff, I'd love to chat with them, be able to show them what options are available with a bank statement loan. Let me know if you have any questions. My team and I are happy to run scenarios for you. This is how you can get in touch with us. Thanks for checking out the video.